Welcome to the What to Watch video update. This is the last video that I prepare over the weekend where I go through all the charts and pick out those that seem to be telling us something right now. And I break them down into three categories: positive, negative, and then those things that we're just keeping an eye on. They're not really either positive or negative, but we want to watch them because they could become positive or negative. And this week we're asking the question, is seasonal weakness coming? Now, the reason why I'm talking about that is I've been watching for potential seasonal weakness going back to the middle of July. If you go back to 2023 and 2024, which were very positive years, we had a downturn about halfway through July in 2023 and 2024, but we came up out of that. It was just a normal decline, and then we went off and set new all-time highs. That didn't happen this year, and we've never had a positive August during a post-election year going back to 1950. We had one this year. And September is the worst performing month for stocks going back to 1950. We're making all-time highs. Now, we've got a little bit left in September, and it's going to be the end of the quarter. It's going to be the end of the month. We've been having a really good run here. Options expiration was last Friday. The again, seasonally, the week after options expiration is more negative than positive. But we've been seeing these things, at least from a seasonal perspective, and they just haven't developed. So we're just wondering, are we going to see any weakness as we try to finish out the latter part of September? Okay, so first we look at the positive side. Now we had an up week. It set an all-time high again on Friday here. We go back to Monday. Monday and Tuesday were pretty lethargic. Didn't really have a big spread between the open, high, low, and close because there was real anticipation for what was going to happen on Wednesday. And we did drift down here, but it's almost like that doesn't matter because at 2 p.m. Eastern time, the Fed came out and announced that they cut rates. And we see the gyration. We went up, we went all the way down, we were all over the place. I usually just step back and watch this during that time, especially when they're actually doing something with interest rates. The market seems to gyrate. Well, then it kind of caught its breath and things were positive. We were able to kind of look back and say, wait a minute, it looks like the Fed is probably going to cut again in October, and it's very likely that they will cut in December. Well, let's turn positive. And so the futures were positive, Europe was positive. That led to a higher open on Thursday. Yeah, we didn't really see a lot of strength during the session. We did gap up. We set a high, but we closed off of the high. The real strong day was really Friday, but that was options expiration where we had a higher open. We came down to the daily pivot and to the unchanged level, and then we saw some strength going into the close. So we ended up being up on the week. It was positive overall. Then we look at the daily chart. We are setting all-time highs here with the S&P. We're a little bit below this pivot point. This might provide overhead resistance. So we just want to keep an eye on that right now. Now we're at overhead resistance for the NASDAQ 100, and I'll show you that chart here in a little while. It doesn't mean we're going to stop here. It's just an area that we want to keep an eye on because sometimes support or resistance in one index may ultimately have an impact on the S&P 500. And we're positive here as far as sentiment, but we're not too positive. And one of the reasons why the market has probably been doing pretty good lately is that you had a lot of people thought it was not going to do good, and sentiment was not really all that exuberant. Last week, this past week that we just finished, we've been setting a series of all-time highs there, not showing a lot of conviction, but still looking pretty good. But we didn't see much of a change in sentiment. Now, we have been coming up. We were down to neutral here just a few days ago. And while we're going up, we tend to go with that. It's positive until we get up close to this 75 level, maybe a little bit below it, sometimes even a little bit above it. We just kind of watch this area. It's not an actual static number. But for right now, we have been seeing sentiment improve, and we still could go up more from here without necessarily becoming too positive, and that could work to the market's favor. We're looking okay, but not great here with the intraday chart of growth versus value. The takeaway is that they're both going up, but we would like to see the blue line above the red line. Okay, we're not really seeing that right now. They're more locked up with each other, but again, the big thing is going back to the beginning of September, we have been seeing the blue line especially rising. and that is positive. And we're positive when we look at growth to value for the mid caps. Now, we're not looking so good with the small caps, even though the small caps are kind of the buzz right now, but they become the buzz and then they fall back, and people get all frustrated with that. We're not doing as good with the mid caps. If you look at the index here, we're doing okay, but we're not really breaking out, and we haven't set a new all-time high. That was set back in late 2024. But if you look at the growth to value ratio, this is actually one of the better looking growth to value ratios that we have right now, where we're above the moving average. We're actually breaking out a little bit above this previous high here, and we're in an uptrend. We're okay with S&P growth to value, but we're below the 50-period moving average. Longer term, we are positive, but we need to get back above this for this to stay positive. Now, this could also be taken as somewhat negative. We've been going up with the S&P, and we haven't really been going up with the growth to value ratio. We like that to outperform when things are more positive, and it has been underperforming. And we look at the Q's to S&P growth to value ratio. That's looking really good. We came down, but we're still above the moving average with discretionary to the S&P, and we're outperforming here when we compare large cap growth to large cap value end of day. And we're looking okay with the large caps and mid caps. We're okay here with the small caps, but not great. We have been able to come back above the moving average, but we haven't been above it long enough for the moving average to really turn back up. We're looking pretty good here. We're breaking out just a little bit here with this growth to value ratio. That's positive. And we are setting all-time highs. We set them a number of times this past week with the large cap growth ETF. That's where most of the strength is coming from. And we have stocks like Apple and Google that are doing quite well now, and they're really leading the charge higher. Then we look at the intraday growth to value ratio for the S&P. Not bad, but not great either. We are above the moving averages. We kind of been chopping around the last few days. We go down a little bit, then we go up, then we go down. Now we're kind of going back up a little bit. We would like to see more of a sustained up move with this ratio that we're not really seeing right now. But if we do start to see that, that would be more positive. And we're looking okay here with the risk on to risk off ratio. When this ratio is going up, that's more positive. And when this ratio is going down, that's positive. This is value to tech, which is the biggest part of growth, and that is positive for the market. High beta to low beta. When this ratio is going up, that's positive, even though it came down just a little bit on Friday. And we're looking good here. This is one of the stronger areas of the market. Discretionary, the second chart down here. This has been doing much, much better. Where staples have actually been going down. They're still in an uptrend, but they're falling below their moving averages. The part that we focus on is the ratio between discretionary and staples, the equal weight. And this is one of the stronger looking areas. And if you remember back a year ago, we had during August, we had that end of the world day where everybody was freaking out. We got beyond that. And then discretionary picked up, and they were the best performing sector going through the end of 2024. You can kind of see that upward move that we saw here with this ratio. So we just want to keep an eye on that. Actually, this is a little bit not really picking up all of it, but some of the big move that we saw. And we're okay with the VIX. We're under 20 and we're below the moving averages, both with the line chart and the bar chart. Not a lot of fear here. But this is a chart that we don't get signals from very often. This is the correlation between the VIX and the S&P. We're coming above this dashed line. Now, we don't know if this is still going to go up more from where it's at right now, but this is when we start to pay attention to this chart. And if you pause this and go back and look, when we spiked and then started coming down, a lot of times that marked the top. Not always, but a lot of times it did. Sometimes it was just a continuation. We don't know how long this is going to last, but it's positive in the fact that we're going up, but giving us a warning sign that we want to keep an eye on at the same time. Now we look at the trend. This is the short-term trend. We are positive. We're above the moving average with the black line. That's the ADX. And the green line is above the red line, and we're also above 20. So this is a short-term positive strengthening trend. Same thing here with the intermediate term. Above the moving average, green line above the red line, above 20. An intermediate term positive strengthening trend. Now, we're still not there yet with the weekly chart. We're turning up, but we haven't crossed above the moving average. But we are positive with the green line above the red line, but we're still below 20 here. We're not trending based on the ADX. This could sometimes signal some kind of a reversal that we're just not seeing yet. And if you look at these are weekly bars up here on the top. These are still looking really good. Higher highs, higher lows, coming up out of the lows that we set back in April, setting all-time highs. Quite positive longer term, but the ADX hasn't really picked up on that yet. Then this is shorter term, 10, 20, and 30 period moving averages. Above all the lines are going up. That's positive. The short-term trend based on 20 periods, above both lines, the lines are going up. Intermediate term trend, above the lines are going up. Above all the plotted moving averages. Now, what we're going to be watching for, because we're kind of far away from the 20 period moving average, that's the top lines here. If we do see a decline, we'll be waiting to see if we get down to this area and what happens if we do. After we came up out of the lows in April, we've had very few days where we've been below the 20 period moving average. And when we did get below it, we didn't stay there for very long. So we're just going to wait and see if something like that happens. I've been watching this now for quite some time and it hasn't developed. But if we do get down here and when we get below the 20 period moving average and then we stay there, that might be a little bit more negative. And then we'll be watching the 50 period moving averages, which are underneath that. And this also is showing, it's called the boom indicator. How far away are we from the 20, the 50 period moving average? This works like an oscillator, and this shows that we're getting kind of far away. And when price does get far away, it has a tendency to go back to the moving average. But we've seen very high readings for quite some time here. So it doesn't mean it's going to happen necessarily right now, but it could happen at any time. This is another thing, longer term. We are more than 10% above the 200-day simple moving average. We're actually over 11% away. Now, if you go back to 2023, that's the dashed line here is at 10%. And we were looking pretty good. We were going up, and then we got too far away from that 200-day moving average, and then we saw a decline. Then we saw it again two times in 2024, going up really nice, got too far away, we saw a decline. Going up here, too far away, we saw a decline. Now, we were watching for this back in July, but we had not even got up to this 10% level yet with this indicator. So that was one of the things that I did a video where I said, this might negate what I'm talking about here for the negative seasonality for July that we saw in 2023 and 2024 because we weren't getting a high reading on this chart. Now we're starting to get a kind of a high reading. But at the same time, there's no magic level that we have to go to. We're just above that 10% level. And at some point, if we keep going up here and we become overbought with our other charts that we're looking at, that might be more of an inclination that we are going to decline. And this is kind of interesting. We're setting an all-time high with the S&P, but we actually went down with the advanced decline line based on price. And we're doing okay, but we were pretty much flat with the advanced decline line based on volume. Now, but in the bigger picture, we're looking good. I'm just picking out what happened in Friday's session. It's a little more negative. And with the advanced decline ratio, we're a little bit below zero here with the blue line. We're just barely above zero here with the intermediate term red line. And we've been going up here with the S&P, and this is setting a series of lower highs here. That's a bit of a negative divergence to be concerned with. And we're just a little bit negative when we look at the advanced decline line based on price. But on the positive side, we are still above zero here when we look at this based on volume. Now, as of Friday's close, we're seeing volume actually outperforming price. We have to go with price. That's the ultimate indicator, is price going up or down. But sometimes we can get some clues by looking at volume. And right now, this could end up being positive because volume is holding up better right now than price is. And we see that here. This is the cumulative advanced decline line for the S&P based on price. Not really doing all that much, but we are breaking out a little bit above this previous high here based on volume. Another indication that volume's leading price. Now, this is positive, but we're seeing a little bit of weakness here. The 10-day average of the S&P 500 highs minus the lows. We got above the green line, but now we're starting to inch our way down here. And even with the update on Friday, we saw this continue to go down. It's longer term, though. It's a 10-day average of the highs and lows. So is there some weakness that's starting to build inside the S&P? That's an open-ended question. We've been watching this come down now, even though the S&P has been making a series of higher highs. Just another warning sign. And we're positive here with the 50-period moving average of the highs and lows. But see how we've been going sideways pretty much all throughout the summer? We haven't really dropped, but we haven't really shown a lot of conviction with this indicator either. And then we look at the new highs minus the new lows. This is an internal measure. We see more green than red. That's positive, but we're still going down with the 5-day chart, and we're pretty much level to slightly declining with the 10-day chart. Now we look at our three smart money indicators, and they're positive. Accumulation distribution above the red line and going up, that's positive. And then a shorter term indicator, another variation of the MACD that I call the boom indicator. This is positive above its moving average. We're a little bit concerned that we're above this red line, but we could still go up from there as well. So this chart is positive. We're also turning back up with the Chaikin money flow. Now, we've been really choppy here with this, but we saw enough of an upward move on Friday to turn the red line back up. And we had been negative for most of the week with the Chaikin oscillator. Now we're back above the moving average and advancing. So all three of our smart money indicators are positive. But Friday was options expiration. Folks that had a lot of options, and that includes smart money players, that had to do something. And according to these indicators, they actually did some buying, and that could end up being positive. And we're positive with the vortex. The green line is above the red line. We're positive here with the Landry light. We're on the day 98 here. This is an uptrend that started way back at the beginning of May, and it just keeps going and going and going. We were a little bit concerned when we got up to about the 40-day level. That's where this dashed line is, but we've just been going ever since then. We're close to 100, so we're more than 2 times beyond that 40-day limit. And then the CMB composite, this is an oscillator. I pay attention to this when it goes above the black line, which is where it is now, suggesting that we are overextended to the upside. And we're okay here with the price momentum oscillator. We're above the moving average and going up. Now, if you notice down here, when we break it out based on price, going down below the moving average, that's a negative divergence. But you see how we're holding up a little bit better based on volume? We're actually a little bit above the moving average. That might be nitpicky, but these are the clues that we look for with these charts. And we look at the studies of all the PMOs inside of the S&P 500. Not doing all that great here. We're below 50 here with the PMOs that are rising. We are turning back up, but we're below 50 with the buy signals. We're still holding up okay, but not great with the PMOs that are above zero. And we're looking good here, maybe a little too good. On the bottom is the short-term RSI, relative strength index. We're getting above that 70 level. And then intermediate term, based on 14 periods, we're also getting above that 70 level. Now, we could still go higher than this. Just because we cross above this doesn't mean we're going to turn and go the other way. It's when we come back down and cross back below 70, that's when the official overbought signal is given. But we're positive with the parabolic SAR daily chart and the weekly chart. And then we look at our momentum indicators here. We're looking pretty good with the short, intermediate, and longer term momentum oscillators. Another momentum oscillator is the Copic curve. That is still positive. And we're getting choppy, not showing a lot of conviction, but we are moving up just enough here to get above the moving average with the bullish percent index for the S&P. Not an awful lot of movement, but still above 50 with the NYSE bullish percent index, and leveling out after climbing back above 50 with the NASDAQ 100 bullish percent index. So these are positive, but they're not showing a lot of conviction currently. Long-term trend line, we're starting to break above the upper end of this trend line. That may act as overhead resistance. We got above it back here in 2021, but that led into the bear market that we saw in 2022. But we could still go higher than where we're at right now. We just want to watch this on the chart. Now we have a daily special K chart. And I don't show this very often because we didn't even get any signals in 2024. But we crossed right at the early part of August. We crossed over positive here. And this is the daily chart. That's positive. And we never did go negative here in 2025 so far with the weekly chart. So these are positive and they're confirming each other. And then here we are setting all-time highs with the S&P, and we have the McClellan oscillator for all the stocks in the S&P going below 50, actually turning negative. Okay. And then we're seeing these longer-term negative divergences, which really haven't meant anything up to this point, since we're setting a series of lower highs as we've been going up. But you'd expect this to be a lot higher with the S&P going up. And let's see, these are the stocks inside the S&P above their 20-period moving average. And again, not negative, but still not looking really strong either with those stocks above their 50-period moving average, 100-period moving average, and we're flat with the 200-period moving average steady. This is more positive though, and I've been really harping on this for quite a while. We got up to this R1 pivot point. We hung under it for about 3 weeks. 2 weeks ago, we finally closed above it, and now we're a little bit further above it now. So we're breaking above this longer term resistance. In fact, I'm calling this now this R1 point actually support, where it had been resistance. We're getting far enough above it. So if we start to come back down, we're about 200 points away. This may act as a level of support. And we're positive here with the equal weight version of the S&P, but we're not setting a new all-time high. Where with the regular S&P 500 weighted index, we did set an all-time high, but we are setting a new all-time high with the equal weight QQQs, which is the Nasdaq 100. So I'm taking this as positive because when we see the Qs leading the S&P, that can often be positive, but at the same time, you could point this out as a negative divergence since we're not seeing new all-time highs at the same time. And the Dow hitting this R1 pivot point. Now it set an all-time high on Friday. It's looking pretty good with its chart pattern, but is this overhead resistance going to be a problem? And we're above this R2 pivot point here with the Nasdaq and setting a new all-time high here. So we broke above this resistance level and we're looking pretty good as far as the chart pattern is concerned. And this is the R2 pivot point for the Nasdaq 100. This is the overhead resistance. We might want to pay more attention to this one because if we start coming down with the Nasdaq 100, the 100 stocks that are in the Nasdaq 100 are also in the S&P 500. And is this going to be a problem? And if you go back and look at other times, you'll notice that these pivot points often can be rather significant. But we look at the momentum for the Nasdaq 100 and it is positive. And a weekly chart of the Nasdaq 100, we're above this trend line going back to 2009. That's positive. Now, we did set an all-time high with the Russell 2000 small cap index. We're positive here, but we haven't set an all-time high with the other small cap index, the S&P 600, that we also follow here. Even though we're in an uptrend and looking okay, we gave over 1% back in Friday's session, but we would like to see both of these indexes setting a high at the same time. And then we look at a ratio between the small caps and the S&P. Even though small caps have been seeing a little bit of favor, they've got a lot of work to do. This longer term ratio has just been going down, 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 down. We need to get above the moving averages, see this go up, eventually generate a golden cross with this ratio. Now, looking a little more positive is the other small cap index, the Russell 2000. Now, we gave back 0.75% on Friday, but this is looking more positive, and this actually surpassed the high set back in 2024. Mid caps kind of chopping along sideways, but still positive nonetheless. And the Wilshire 5000, a broad market measure, this is setting an all-time high, as is the total U.S. stock ETF. And the financial sector, it's looking pretty good. It's above its 50-day moving average. It's in an uptrend, but when we compare it to the S&P 500, it's back to underperforming. And we would like to see this doing better, like we were seeing earlier in 2024 and about halfway through 2025 or so, before we really hit the difficult times in March and April. The FANG index, these are the really big stocks setting an all-time high here, and that's what's really driving the main indexes. And the Dow Jones Semiconductor not setting an all-time high here, but we did set a new all-time high with the SMH Semiconductor ETF. So you could say that as positive, that one's setting an all-time high and the other one isn't. You could say it's negative because one is not showing the same result that we're seeing with the other index. And this is looking okay, but not great. The semis to tech ratio, we want this to go up, and it was really going up after Thursday, but it dropped down after Friday. We would like this to be better. This going up would be more positive for the market. And we are going down here, which is positive. Staples to tech, going down, down, down. That's positive for the market. We look at the Qs, the small caps, we're above this blue line, and we've been going up with this ratio. That is positive. Semiconductors to the Dow, that's also back above this blue line here. That is positive. And I kept this on the positive side just because of the S&P. We're above the moving average with the NYC common stock and the S&P, even though we declined slightly. Where we're seeing a little more weakness is with the mid caps and the small caps down here. We're below the moving average. Now, this is positive, though. We look at the 5-period moving average of the highs and lows across the broad market, and we're still going up here. That's longer term positive for the broad market. Now we look at a number of different stock to bond ratios. we're setting a new high here. When we look at the S&P 500, the 3 to 7 year bonds, the market is thinking, okay, we're going to have a soft landing, meaning that we're not going to go into a recession. And that's what the market has been thinking. Now we see, is this confirmed by other stock to bond ratios that we look at? This does confirm that. This is that same chart, but inverted. This is 3 to 7 year bonds showing how they're underperforming stocks. We look at the S&P 1500, the short-term bonds, breaking out, setting a high. Broad market measure with 3 to 7 year bonds, breaking out, setting a high. The Qs to 3 to 7 year bonds, breaking out, setting a high. Tech sector to 3 to 7 year bonds, breaking out, setting a high. And then, so those are pretty positive. And then we look at the S&P to utilities ratio, and this is going up. That means the S&P is outperforming. If this could continue to go up, that would be even more positive. And this is another Staples to S&P. This ratio is going down, and that is positive. The NASDAQ 100 to Dow, that's growth to value here, way above this red line and going up with this ratio. Now we look at the negative side, and this is the S&P McClellan oscillator, also showing a negative divergence. We've been going up with the S&P, and you can see the series of lower highs here, and we're actually below zero, and we declined in Friday's session. A little bit of a concern. That means that there's not a lot of strength throughout the S&P 500 now based on this indicator. And when that's below zero, we're still declining based on price. That's negative. But we're still advancing here based on volume. This is another one of those areas where we're seeing volume going up and price going down. That could end up being positive for the market. Then we look at the NYSE McClellan oscillator. This is a broad market measure, also seeing these negative divergences as the S&P's been going up. We dropped below zero on Friday. And again, you wouldn't necessarily expect to see that when we're setting all-time highs. So we're coming down just a little bit. We're not really getting much from this. We're kind of chopping along sideways based on price and volume with the summation index for the NYSE. And we're getting a mixed signal here. Swindle trading oscillator. We were declining based on price. We turned up. We're declining still based on volume. So this kind of goes against that idea that maybe volume is leading price. Price is actually going up where volume is going down. Then this is the NYSE Zohorchak method, a very long-term buy or sell signal. We are at -6 now, and that hasn't moved since the last time I did the video. So that is still negative. We would like to see this get up to a higher reading to actually turn more positive. And this is the small cap growth to value ratio, where we came up on Friday, but you can see as the small caps have been going up, this ratio has actually been going down. And a little bit of a concern there. Now, I personally don't deal with the small caps, but sometimes we can get some hints by looking at the small caps of the overall condition of the market. Then we look at home construction. This had been on the positive side for quite some time. Now, it's kind of interesting. The Fed came out on Wednesday and cut rates. And since then, interest rates have been going up. And we saw that a year ago, too, when they cut it 0.5% in September of 2024, and then interest rates started going up after that. We're seeing a similar thing here, and this hurts this overall ratio. Home construction to 3 to 7 year bonds, because this is a very interest rate sensitive area. It had really been improving. Now we're starting to come back down into the rainbow. And some things we're just watching. This is the seasonal chart that I'm talking about here. This is put out by Stock Traders Almanac, and they come out with a book every year, and they do all kinds of different research. We will be on day 15, the trading day, in Monday's session. And we did see a tendency for more positive seasonality, but now we're seeing more negative seasonality as we finish out the month. So, and I follow the green line here. That's the S&P 500. And this is earlier on. This is when I saw this chart. This is what had been happening up to that point. Is this going to matter? Is this going to turn into something? It hasn't yet, but it could start to turn into that in the upcoming week. Also, when we look at the second half of September, that is the worst performing half a month going back to 1950. And we're in that window right now. Not predicting anything. We want to watch price. We're not really seeing anything falling apart yet, but just be aware of that. And then again, I have this thing called the advanced decline oscillator. We've been going up with the S&P, and this has been going down, and we're actually below zero even after Friday's advance. And then we want to keep an eye on the employment numbers here. We actually came down This was a nice surprise, and this really gave a boost to stocks on Thursday when the red line came down, and we're coming down, but we're still pretty much range bound with the continuing claims. And then the latest reading of unemployment was at 4.3%. And you can see here the weekly claims really dropped off here. The market liked that because now we're back down into this range that we've been in for a while. And the continuing claims did decline. It'd be nice if they kept coming down. That's been one of the concerns of the market, is that the employment situation is not doing all that well. This kind of goes against that, at least for right now. And this could be taken as negative. This is a weekly survey of the American Association of Individual Investors. Now, individual investors, that includes you and I and anybody watching this video. We are individuals. I actually belong to this organization, but they do a survey. How many of you are bullish? How many of you are bearish? One of the things that has helped the S&P go up is we've seen consistent bearish readings with this survey. And even with the latest reading, this comes out and I put it in Friday's daily video. It's improving, but we're still negative. We're still below zero here. And this could help the market to go higher because individual investors tend to chase what's already happened. And we've been going up with the S&P, and they're like, oh my gosh, I'm going to be left behind. Oh no, I need to get in. And that's like a capitulation to the upside. And that could happen because you have a lot of individual investors who are still negative overall here. If we get this up to a really high rating, that's usually where we see some kind of a more significant top. And then we want to keep an eye on the 10-year yield. We came down and tested this 4% level twice, and now we've been going back up, and we've been going up since the Fed cut rates. Go figure on that one. But that's what's been happening. Now, if this continues to go up, the stock market may notice that at some point and go, uh-oh, we don't like this, because they tend to like lower interest rates. And we look at the relationship between bonds to see, is the market concerned about inflation and interest rates? This ratio here, cash to 3 to 7 year bonds, when this ratio is going down, now it did come up a little bit here, but overall it's been declining. That's showing that the market is not concerned about inflation and interest rates. When this ratio really goes up and is actually trending up, that's when the market is concerned about inflation and interest rates. And we pretty much have been going sideways here after declining with tips. These are Treasury inflation protected securities. They adjust for inflation. They're shorter term. When the market's concerned about inflation and interest rates, they get into tips and they outperform. When the market thinks that interest rates have topped out and they're going to come down, then they jump over into 3 to 7 year bonds. Not really seeing anything all that drastic here. We are in an uptrend with this ratio, but after really coming down, we go up a little bit, we go down a little bit, not showing an awful lot of conviction. For right now, I'm taking that more as the market is not worried about inflation and interest rates. We do that same thing here with tips to 7 to 10 year bonds. And again, we're below both of the moving averages, not really showing an awful lot of conviction lately, not a lot of worries in the market. We want to keep an eye on the spread between risky and not as risky bonds. This is going up. That means there's not a lot of fear. As this continues to go up, that's more positive for the bond market, which often turns out to be positive for the stock market. And we want to keep an eye on the large cap to small cap ratio. Going back to 2021, you can see how this ratio has been going up. That means the large caps were outperforming. Well, this is starting to come down a little bit, but we're going to need to see more follow through with this. When this ratio goes down, that means the small caps are outperforming the large caps. And we want to keep an eye on oil, mainly for geopolitical reasons. We're getting more down into the lower 60s now. And we want to keep an eye on retail. Now, retail sales came in really solid here. And the middle area, that's retail, where we're in an uptrend. We're above both of the moving averages. Then in the top part, we do a ratio between retail and the S&P, where it had been underperforming. We're starting to flatten out and going up ever so slightly here. It would be more positive if this ratio was to go back up. And we're also positive here with the RSI. We're above 50. Then we want to look at some different ratios here. The top part is the weighted discretionary to staples ratio. The reason why that's kind of a big deal is in discretionary, you have Tesla and you have Amazon. And they are huge companies, and whatever they do has a real impact on this sector. So when we look at this sector with the weighted version, it's looking pretty solid here. We're also looking pretty good when we look at the equal weight version of this ratio. It's going up. We're looking pretty good with tech to utilities, That's positive. Biotech to healthcare, that's growth versus value. But we're not really doing as good down here with hotels to utilities. That ratio hasn't really been breaking out at this time. But the other ones are looking pretty good. And we have what are called bellwether industries here. Semiconductors looking pretty solid. Not all that great with the home builders. Even though interest rates have been cut, we've been coming down here, going sideways with the transports, doing okay here with retail, and kind of going sideways overall with the regional banks. These are the smaller banks, but we're not seeing an awful lot of weakness here either. We keep an eye on the gold to S&P ratio. I only pay attention to this if we get back up to this yellow line, and we're not there yet. We look at US versus international stocks, kind of range bound. If you go back into August, we were improving here as US stocks were trying to outperform stocks across the globe, but we've kind of gone sideways with that overall ratio. And then we look at emerging markets versus developed markets. Developed markets would be the US and Europe. And emerging markets have really been doing quite well. You look at the chart, and that's really doing good compared to the US market. They're setting highs there. And so that's why this ratio is going up. Momentum stocks, which tend to hold up better. This is when we were going down back in March and into April. This ratio was going up. And then we kind of are going sideways more or less here. Not really seeing, but we spiked up and then came back down. Now we're starting to turn up a little bit again. We'll keep an eye on this one. And this is the dollar on the daily chart here. Even though we've bounced up the last couple of days, we're still in a longer term downtrend. And on the weekly chart, we're in a downtrend as well. But if this continues to bounce up, that could put some pressure on stocks. We want to keep an eye on the German DAX, mainly just for reference, where we're setting new highs in the US. We're not setting all-time highs here and falling below the 50-day moving average with the German DAX index, and that's the biggest stock market in the EU. And so this ratio has been coming up. This means US stocks are outperforming German stocks. But US stocks are now outperforming global stocks, but they are holding up a bit better when compared to German stocks. And these are the pivot points for Monday. If you go to the website, if you're a member, it's included in the video there, also in the newsletter that I have. And I post this also on the YouTube community tab. Thank you. Have a wonderful weekend, and I will talk to you in the next video.